Today is Tuesday, January 13th, 2026. I just wanted to put together a quick video on my thoughts of the market today. Usually I record these videos for myself. This is how I journal my trades, but a quick recap. The perspective that I view the market is I'm usually looking for breakouts, pullbacks, and second legs. I trade bar by bar using the Al Brooks methodology. And if you guys are familiar with Ali, I also code systems. I coded all the systems that I trade myself based on breakouts and second legs and directional probability. After you do systems, after you go through the market level 1, 2, and 3 study, you just follow the system and you tend to focus on the nuances. So right now, the nuances that I'm focusing on is the fractal nature of the market, focused on my lower time frame as my higher time frame trades develop. And the reason being is I want to have a more discretionary view of the success and fail cases on the 5-minute, while also being able to analyze their behaviors on the lower time frame. For me, that's the 100-second. When I was doing my 100-second study, I characterized the bar in 3 phases. Phase 1 is the first half of the bar, phase 2 is the second half of the bar, and phase 3 is the last 30 seconds. And based on the behavior of the first half, the second half, and the close, and if the bar closes as a trend bar or a trading range bar, I have calibrated expectations on what I think the market may or may not do. I do not make trading decisions off the lower time frame. I'm just looking at the internal structure. And what I do is I categorize the trades that I take looking at the 5-minute context, whether it's a successful case or a failure case, and I categorize them based upon the market context of the lower left right here, my 100-second chart. And I categorize it in these 6 categories, and based on what category the lower time frame is doing in contrast to the context of what the 5-minute chart is doing, I collect that data to better make trading decisions when the lower time frame structure starts to represent that of a failed case. So I wanted to start on the 24-hour chart. I normally don't take trades till 10:10, 10:15-ish. We had CPI news and we had a strong bull breakout with no follow through that immediately reversed during the open. And what the open looked like was we had a bull channel from the prior day, tested its low, immediately reversed, outside up bar plus follow through, higher price is likely. However, if you look at the location, we're still below this high, so we need one more bull bar to show some type of sustained strength. Otherwise, we're at the top of a channel, we have a trend line break, and we have weak trend resumption. So there are going to be bears looking to sell for some type of reversal or trading range. We get the attempted breakout, immediately reverses, tests the midpoint of this channel, then closes above its midpoint trading range bar with slight bearish strength. So we already have a leg 1 pullback up. In these 3 bars, we have 2 legs already. Bulls looking to buy, they already got their second leg. You have to be careful in this environment. Then we get another push down and another push up. So now if we're looking from the bear perspective, we have 1 leg down, pullback, second leg, pullback. So now we're in an environment where both the bulls and bears have 2 legs with trading range price action. So trading range is expected. So right now, what's most likely is that we're going to stay within a trading range. Another trading range bar, we went up, we went down, another leg in both directions on the lower time frame. So now we have a triangle. So the market is looking to break out either in the bullish or bearish direction. Leg 1, pullback, leg 2, pullback, leg 3. So this has 3 pushes down. Push 1, pullback, push 2, pullback, and then in here maybe may have been a second bull leg. You don't have to get that deep with it. All you have to know is that we got a bunch of trading range price action, so we're expecting a trading range. Another trading range bar, however, it closed on its low. It's an inside bar, so because it's an inside bar, that's volatility contraction. If we get a breakout, they'll likely be expanding aggressively. That's what the bears want to see. They got that acceleration, however, immediately reversed at the 200 moving average, and then we got another push up. So this whole thing can just be 1 leg, and we might need a second leg down for this, because theoretically this is a micro channel with the exception of the inside bar, but we have lower highs and lower lows, so second leg down likely. We get another inside bar, which is a pause bar, good for the bears bad for the bulls, but also somewhat bad for the bears, because every attempt that they get for lower prices, price pushes higher. So imagine that you're selling, and every time you're in profit, it goes back on you, profit goes back on you. So these bears are not having a good time. Then we get hesitation at the 200. This still looks like it can be one leg, so I was expecting we're gonna get one more attempt to push down, because this one bull bar is not enough to undo all of this. Then we got a reversal down expected, bad close expected, trading range price action expected. So at this point, I'm thinking we may get some hesitation at the moving average and some type of reversal. Another bear bar down. This might be our second leg, so this might be leg one, pause, leg two. But this still has immediate probability. I thought that I should wait on the market's response. Response was hesitation as expected. Weak buying expected. We get an attempt up and a reversal down. Now we have a tight trading range, testing the high of bar 11. However, the breakout point is a little bit higher. If this breakout point stays open, then I'll probably look for lower prices. If this closes, I'll look for higher prices, but I'm still expecting trading range, because all of this is trading range behavior. More hesitation, then we get an outside down bar. However, look at the close. The close is still above the low of this entire trading range. So we're just in a trading range right now, and I don't want to sell at the bottom of a trading range. We get a big bull bar. So a lot of these bears may be taking profit. Bears who sold here and sat through this big pullback, got a little profit, decided to exit the trade. Strong bull bar, closing above the prior 1, 2, 3, 4, 5 bars. Higher prices likely. Hesitation, but still good follow through. Then we get a reversal down. When you have a strong leg like this, the last strong bear bar, usually there's sellers above. So sellers above here, here, maybe here. But this outside down bar, sellers above here. So if there were sellers here, they're trapped right now at this price. We have to see the response to this. However, bears likely are going to attempt to go lower and fail. We need a second leg for this reversal up. We get a reversal up. Is that enough for a second leg? Maybe, maybe not. 200 moving average is in the way. Outside bar follow through, good for the bulls, terrible for the bears. We're getting breakout price action in a trading range, and bears who sold here and wanted to sell more didn't get an opportunity to break even, and now they're immediately in a losing position. So they tried to sell here, tried to sell more here, still in a losing position. Then we get another reversal up. No opportunity for bears to make any profit. Test of the last swing is likely. Hesitation. Then we get a strong reversal down, which is also a first test of the moving average. And it got right to that price where the bears were trapped and immediately reversed up. So that is an indication that in everywhere within this tail of this bar, there's going to be buyers. Higher prices likely. And even if we get to these lows, trading range likely. Reversal up expected. 3-bar micro channel. So we got leg one, hesitation, leg two, but this is strong, likely hesitation and another leg up. If not, generally in trading ranges, the highs of the trading range tends to be a magnet, so we could get quick acceleration up. We get the acceleration, tests the high of the moving average, hesitates, attempted reversal up. This looked like it may need a second leg, but remember, in a trading range, leg one, pullback leg two, trading range, second legs are generally stronger than the first leg. That's how they tend to trap traders. Here, we had a weak first leg, an accelerating second leg. This accelerating second leg did not produce another leg in comparison to this. Same thing here. From this to this produced a strong second leg. So the expectation now is higher prices likely, but in a trading range environment, traps are common that accelerate to support and resistance. At this point, I would do nothing. Second reversal down, 2 consecutive bars with strong bearish IBS closing near their lows. Then we get another bar closing near its low, and we have another 3-bar micro channel. However, at this point, a second leg is still expected, but the immediate probability is that this should get a second leg. So right now we're in an environment where the bulls have an expected second leg and the bears have an expected second leg. And when that happens, you're essentially in a trading range environment. However, we don't know the location of the trading range. This might be the upper trading range, or this whole day might be the upper trading range. Currently, our expected range is from this high to this low. And generally, if we test the high of the trading range, it'll go to at least the middle. So current expectation is we test the 200 moving average. Price reverses up, fails, 200 moving average test, minimum expectation met. However, Bull bar causing you to buy at the high of a tight trading range with a lot of risk. So you're buying in the upper third of a trading range in a trading range day where there is a second leg expected in the other direction. Never triggers, fails, reverses. Get 2 consecutive bear bars closing near their lows. Immediately reverses up at the 200 moving average. Outside down bar, bad for the bulls. But again, although bears are in control of this tight bear channel, the behavior of this channel is trading range behavior where both bulls and bears are able to make money. Whenever both bulls and bears are able to make money, the market's generally in a trading range. Outside down follow through, lower prices expected. However, we're getting to the low of bar 24 where we immediately reversed last time. Hesitation at that same location. The first push up. However, after all this bearish momentum, this bull bar is not strong enough to undo everything, so lower price is likely. Maybe it'll fail and then we'll reverse up. Surprise bar, instead of getting a push down, we get a push up. However, still within a trading range, so expectation of this second leg is still valid. Pause bar at the 200. Sellers likely above and below, expecting a test of these lows at a minimum. Hesitation. Now we have a tight trading range, which is a triangle. So we're back in that environment where both bulls and bears can make money. Then from there, as we continue to go, more trading range behavior, breakout, weak breakout, follow through, hesitation. Even though there is breakout and follow through, there's hesitation and we're near these lows. Getting close to the close of bar 16 where there is another potential location for trap bears to exit a position. We go lower, 3 consecutive bear bars with a strong bearish IBS. As we said, generally in trading ranges, we get strong acceleration towards support and resistance areas. Strong acceleration at the end of an extended tight bear channel is not uncharacteristic. This whole thing could be a leg 1, this whole thing pullback leg 2. For me, leg counting, pullback, all that stuff, I just wing it. There's no precision for me, so if it's good, it's good enough, and I just keep it moving. Hesitation. These trap bears never able to exit. Reversal up. Hesitation at the moving average. Testing this breakout point, failed twice. Testing a third time. Failing a third time, bear bar closing on its low at the moving average. First touch of the moving average since we closed below the moving average, so likely lower prices. Hesitation again, tight trading range. So we went from an upper tight trading range to a lower tight trading range. At the middle price is where price is hesitating. We reverse again at the breakout point, still an open gap. Third reversal down, lower price is likely. More hesitation, reversal up, but again, at the midpoint of this trading range. Even if we get up here, we're just going to be in the upper limits of the upper trading range. So right now, expectation is we stay within this range. Maybe the bears get out of their trap position, maybe not, but we're not going to go too much higher. We're not going to go too much lower. Getting late in the day. Hesitation, breakout, reversal, second breakout attempt, closing below this upper range, reversal again. So now we're in a tight bear channel. Push down, push up, push down, push up. So again, trading range behavior on all fronts, bulls and bears. Another trading range bar, hesitation, pushing down, testing this low. At this point, a new low of the day is likely with this momentum. Bears get their opportunity to exit, new low of day. However, trading range price action, unlikely that we get a bear breakout and follow through, likely a reversal in the test of this high range, maybe the upper range. Reversal up expected. 2 consecutive bull bars closing near their highs with high IBS at the bottom of a trading range. That's buy to close. Bulls buying, 3 consecutive bull bars with high IBS. Bulls are buying. If not, they're going to buy the midpoint. We get an acceleration up, closing above the past 10-20 bars, so expectation is higher prices, and that's what happened into the close. That's kind of just how my thoughts ran throughout the day. I kind of just look at each bar one by one, and I think to myself trend bar or trading range bar, and I just make my decisions bar by bar based off of that. I hope this helps out. God bless.